Hi all, welcome back to another video. Now today we are going to discuss about business valuation. Now this topic is a very important topic in FM of ACCA. Now financial management or in AFM also, like we need to value a particular company. What should be the value? Okay, that we need to consider. So essentially what we are talking up today is business valuations. So why do we need to value a business? That is again a question. Okay, so if I'm going to buy a new company, I need to know how much I should pay for it. So this would be like a minimum amount I should be looking at, or if it is going on a particular level, so it would be like what is the maximum I should be paying for it. This all questions would be there in one's mind if we are doing it for the first time. So business valuation, there are some techniques we are using in place to find out what would be the value we will be using to put forward a takeover bid, or to bid, or to price what is your amount you are paying for the particular company. Excuse me. Now coming again, now consider an example of Sonic PLC. Now, this is a particular company, an imaginary company we are looking at. So, this Sonic PLC, if we are going to buy it, we need to consider two things over here. Okay, every company might be having, like as we studied in the sources of finance, there will be an equity capital coming from it, and there will be some funds coming from the debt as well. So we need to consider valuing the equity also and valuing the debt also. So we'll be covering the valuation of equity in another video. So there are like in summarized form, there are like three bases on which, or three bases on which we can calculate the value of equity. We can go for an asset based valuation method. Inside asset based valuation method, we could be simply using what is the book value in your financial statement, or an NRV basis, which is like if the company is going for a liquidation or a breakup basis, what would be the value? That is the NRV basis. And the replacement cost, if the company is going on a continuation basis, like going concern issue is not there, then we can consider the replacement cost. And one thing to focus here in for the replacement cost is that replacement cost, if you have take an example of a mobile. Okay, so you have a particular mobile with you which is 2 years old, and some RAM capacity is there. Let's say storage is 128 GB, all those things. So if I have to replace this particular mobile which is 2 years old with the same condition, like what is the capacity, what is the specifications you have, current conditions. So based on this particular current condition, if I replace it with the same condition with the same age thing, what would be the cost? That is a replacement cost, and it is a bit difficult to find out because normally it is very difficult to find out the same kind of asset on the same condition. It is very easier to find out in the case of the mobile phone itself. In the case of mobile phone, like for example, like you're replacing your existing phone with a new one, then it is not a problem. But in case of replacement cost, we have to see the exact same condition mobile need to be replaced with the same thing only, not a new one. So that is going to be a particular problem because the current condition of our asset might not be the same. So this is the asset basis. Now coming to the income basis, we have two methods again. We will be using something called a P ratio, price earnings ratio. So rearranging the formula over there, we can calculate what is the price per share over there for the equity share, and we can calculate what is the market capitalization. Now what is market capitalization? Basically the number of shares into the market value of shares we are looking at. So P ratio can be used, and earnings yield is another method. Earnings yield is nothing but the reciprocal, or let's say 1 divided by P ratio is what is your this thing earnings yield is. So we can use that also to calculate the income based valuation for the equity. What you need to focus here is that we are considering methods for valuation of equity over here. Okay, and again while using which P ratio to use, if the particular company we are talking about, Sonic PLC, we might not have a PE ratio available with us, or even they have given you a PE ratio for the particular company, we might not be able to use it because they might be, we are not sure whether it is the right one. Okay, so normally in the exam point of view, from the point of the examiner, they might give you a PE ratio which can be directly used, or they might give you a PE ratio of a similar company which might be quoted or unquoted depending on the situation, which need some adjustments based on it. That we will cover more during our next video. Okay. Now the third method of valuing equity is cash flow based ones. So this is the method which is giving you the highest value for the equity. So the maximum value we'll be looking at would be based on a cash flow basis model. So there are two methods: dividend valuation model, which you will get an ex dividend share price. We might have studied that in the sources of finance chapter or cost of capital chapter to arrive at what is the cost of equity using the particular thing. So rearranging the formula, nothing but rearranging the formula, you will get the ex dividend share price. And here we need to focus one thing over there, that you're calculating an ex dividend share price, but sometimes if the dividend has been just been announced, that value needed to be added with the share price to arrive at the current market value, because that expectation would be there in the price. So it's not ex dividend, come dividend price would be the current market value if it is being announced only. So if it is being paid, no problem. Paid meaning that it would be excluding dividend only, so no need for an adjustment here. Okay, now coming to the last model in the cash flow based model, that is the discounted cash flow model. Effectively, like we are considering the discounted value or the present value of the future cash flows, or we can say that we are just looking at the NPV of the future cash flows over there. So we are not calculating NPV, we are not deducting any initial investment from it, but we are looking at what is the future cash flows and we are discounting it to the current date. That is what we are looking in here. Now, these all models and problems we'll be doing in the next video, and one need to focus on the DCF model, discounted cash flow model. While doing it, we will be getting the total value of the company. So in order to find out what is the value of the equity, we need to minus the value of the debt from the total value of the company. So this is only applicable for the discounted cash flow method, which we'll discuss further in the next video as discussed earlier. Okay, now in this video we will be primarily focusing on how to value the debt. So essentially there are like four kinds of debt we are looking at. We are considering preference shares as a debt as well. So this preference shares, irredeemable debt, redeemable debt. Now what is a preference share? It does have some preference over the equity shareholders. So preference shares is that, so we are effectively treating it as on a debt only. Irredeemable debt meaning like there is no need to pay out the principal amount. So it is like for a perpetuity, for a foreseeable future. We are not for the foreseeable future, for a long time till what we can predict. We are receiving or we are paying interest only. So that is the irredeemable debt. Now, redeemable is that the debt is taken for a fixed period of time, after which the principal will be repaid. Now, there is another thing called a convertible debt, meaning like at the end of the term, like as in the case of a redeemable debt, they will give you a conversion option over there. They will give you a conversion option over there. So at the end of the term, let's consider a 7-year debt that is there. So at the end of the 7th year, they can either take the principal amount or they can convert their debt into equity holding of the company. So that is the option we are looking at. So how to calculate the market value of these things? Pretty simple. For preference shares, we are using a formula which we have already used in the cost of capital calculation. We are rearranged that particular thing. So it is P0, that is the price of market value of one preference shares would be equal to the dividend divided by the cost of preference shares. So if you have the dividend and cost of preference shares with you, it is very easier to calculate what would be the market value of the preference shares over there. Same with the irredeemable debt over here. So irredeemable debt, you are calculating the market value of the debt by simply dividing your interest with the required rate of return by the debt holders. Okay, so what is that particular required rate of return? So assuming that my interest is 7, I can divide it by, let's say, 5%. If the required rate of return is 5%, I can divide it to get the market value of an irredeemable debt. Coming to redeemable debt, it is a little bit different because we need to consider the present value of the future cash flows from it. So that would be the market value at present time, or consider the current time as t0. So let's consider there is like one particular redeemable debt which is for redeemable after 7 years. So we will be receiving interest for 1 to 7 years. So for this 1 to 7 years, interest need to be taken. You will be using an annuity factor on the required rate of return, and we'll be calculating what would be the present value of the interest for this particular 7 years. And on the 7th year, you would be having a redemption value. Now redemption values, sometimes or most of the cases, it would be the nominal value itself. And if it is not the case, it would be shown in your, it would be given in your exam question, whether it is redeemed at a premium or it is at a discount. That we need to consider what is the value. So read carefully the question requirements and the question facts. You need to focus very carefully, because if it is on a premium, then the final value would be changed. So redemption value would be at a premium. So let's consider 10% premium. So normally a debt nominal value is 100. So 10% premium, meaning that you would be redeeming it at 110. Okay, which is effectively 100 into 1.1 or 110 percentage. Okay, so that is the case over here. Now coming to the convertible debt, we need to consider two values. So market value of a convertible debt would be either, okay, what would be the value of the debt if there is no convertible option, or what would be the value now if you are converting it. Okay, so if I am having a convertible value, so let's say that I am expecting, after the same example, after 7 years, I can convert this into 30 shares at, now the current market value would be the same. So one debt can be converted into like 30 shares, meaning like that 30 shares, what would be the value of conversion? We'll compare both. Okay, so assuming that the debt value is only 100, and the conversion value, we are not looking at the total value, we are looking at the redemption amount. So what would be the redemption value if we are redeeming on that particular case, and what we'll be looking at, what would be the conversion value? We are comparing it to see what would be coming over there. So what would be the highest of these two things? We'll be considering it as a value of the convertible debt over here. So now let's focus on doing some questions over here. Now let's consider your first thing over here. So preference. Okay. Now see the question. What is the value of the preference shares? So a firm has an issue of 12% preference shares with a nominal value of $1 each. Currently, the required rate of preference shareholders is 14%. So basically what you need to focus over here, we need to use a formula. So let's consider, let's copy paste this particular thing, or P0. Okay, I can use for the other thing. So let's consider it over here also. So for reference purpose, I'm putting it over here. Okay. So as you can see over here, preference share can be calculated using your dividend. What is your dividend? Dividend divided by the cost of preference shares. So in this one, you can get what is your value of D, what is the dividend that you need to calculate, and what is the value of KP, cost of preference shares, that you need to find out. Cost of preference shares is the required return on the preference shareholders. That is now 14%. Now 14% is there. Now what is dividend? Dividend, you need to calculate 12% is a dividend, and 12% on the nominal value. So $1 multiplied by 12% is your dividend. So that is your dividend. So just putting in the equal to over here. So 0.12 is your dividend. Now what you need to find out, your value of this preference shares would be, okay, you just need to multiply or divide your D divided by the cost of preference shares, 14%. So you have a particular value of 857,143.85 as your current market value of the particular share. Meaning $1 was a nominal value, but now it is being traded on 0.85. 0.86. Okay. So this is what we are looking at. So again, this is pretty simple, right? So we have to use a particular formula over there to see what is being what is the value. So use a formula, get in. This is pretty straightforward. So you use a formula and get the figure over here. So again, the value over here is like $0.86, or you can sell just tell it as on a cents also. So it is like either dollar 0.86, or you can go for okay on a cent basis. Okay, so this one, like if I go to multiply it with 0.86 into 100, 85.71 would be a on a cent, like 85.71 would be a cent basis value of this particular market value of this particular preferentials. Now coming towards the second question, which is relating to a redeemable loan over here, this we can calculate using the same thing, like same formula over here. So market value of the redeemable debt is equal to interest divided by the required rate of return, or the cost of debt basically. So let's say what is your interest over here? I is your 7%. Okay, interest is your 7%. Now we need to consider what is your I or interest. Okay, so as you already know, like we can assume that a debt or loan note would be having a nominal value of 100 always. So 100 into 7% would be your interest, the cash flow that is being coming up. So 100 into 7%, 7. Now you have a required rate of return R. Okay, R is equal to, they have given you as 4%. So you need to just divide it using what? 7, that is your interest, divided by the rate of 4%. You will get $175 are the market value. So market value of one debt, market value of debt in dollars. So this is also straightforward. So we can just go for calculating this value using the given information from the question. So this is pretty straightforward also, just like the preference shares. You just need to use a formula and apply this particular concepts over here. Okay, now coming towards a little bit tricky situation for a redeemable basis. So as you can see over the question here, we have so many information rather than the other thing. So a company has an issue 9% redeemable debt with 10 years to redemption, and redemption will be at nominal value, and the investors require the return of 16%. Now what you need to consider, I need to rearrange this putting. There is a format we need to follow. Okay, one thing is like you need to get like at what is the year or term. Now you need to look at what is the cash flow we are coming out, and then what is the amount we are looking at. Then we will be looking at the discounted factor. Okay, now at the required rate of return over here, what is the investor's required rate of return? So discount factor, or in short present value factor, at the required rate of return here is 16%. That 16% you need to get it from the table over here. So then you will get the present value. You will take the total of this particular thing to get the value of or market value of the debt. So this is the format you have to use it for calculating the value over here. Now let's consider what are the cash flows coming in here normally. So you will be having for year 1 to, okay, this is redeemable in 10 years. So year 1 to year 10, there will be a cash flow that is coming as your interest. Okay, so while calculating the market value of the debt, there is no need to deduct any tax or something, like 1 minus t is not applicable here. You can take directly the what is the interest over here. So assuming that, not assuming, normally it is like 100 only, one debt would be $100 nominal value. You will be paying a coupon rate of what? 9%. Okay, so into 9%. Now there is one thing you need to focus here. What is the percentage along with the name of the debt is the coupon rate, and the interest cash flow will be computed based on that. Repeating once more, the interest cash flow will be calculated based on the coupon rate, which is the percentage mentioned on the left side of that particular debt name, or redeemable at 9%. So I am using 9%. So this will be your interest for 1 year. So coupon rate, the cash flow will be calculated using the coupon rate, but discounting would be at the required rate of return. Now again at the year 10, now this would be your redemption value. Year 10 you are redeeming it, so you will be having a redemption value over here. So redemption value, you will be considering what? 100. It's redeemed at nominal value. It's no premium, it's not discount. They are selling redemption at premium, sorry, redemption at nominal value. So we are taking the nominal value as 100 over here. Now we need to get the present value factor for 10 years, year 1 to year 10. So we are using the annuity factor, since the interest of 9 is repeating on year 1, year 2, year 3, year 4, like that it's repeating. So we are taking that particular factor from there. So let's consider a particular factor. Let's refer to the table. So I'm just referring to the table, and let's get those particular figures over here. Then it will be very easy to solve it. So your formula, don't worry that you will be given this particular tables, annuity table, present value table, everything would be given in the exam. So there is no need to worry. So you just need to refer it to it and take it. So at 16% for 10 years, the value would be 4.833. So we are considering the value over here, that is 4.833 is your present value factor, not present value factor, annuity factor at 16% for 10 years, year 1 to 10, 10 years. Now what would be the present value factor on the year 10? Only one value, 1 year is coming up. So we are using present value table. So present value table for 16% for 10 years is 0.227. So we are just considering that figure also here, 0.227. So 0.227 we are using it over here. So what do you need to just multiply this particular here? 9 into 4.833, 43.497. And same way, you need to multiply 100 with the present value factor over here, 22.7. And you can add these two things together to arrive at the current market value of the particular debt. So the figures you can round it to two decimal places. So 66.20 would be the market value of debt now. Okay, so this is the market value of debt now, 66.20. So we just need to focus on two things. One, you need to follow this particular format. Your cash flow, the amount, present value factor, and the present value. You need to consider this thing. So basically that is one thing you need to follow. So if you use this particular thing, you can get the value over here. Now coming to the next one, that is relating to the convertible thing. You are calculating the market value of this thing on the same basis, because we are following the same method over here, and we'll be using that over in the convertible option as well. So we'll just consider that later. Now I hope this one is clear for you. Like, one thing is that while calculating the cash flow for the interest, you will use a coupon rate, but the discount factor need to be taken at the required rate of return of the investors. So 66.20 is the market value of debt as per this particular question. Now move on to the convertible options. So convertible loan notes, as we mentioned, we are doing it the same method. I'm just copy pasting over here. We are going to calculate the value of these things on the same method over here. But what we need to consider, a little bit change we need to consider over here. Again, the percentage will change. Okay, but here there are two questions. One is whether we need to convert or not. That is the thing. So before that, we need to consider some concepts called what is the market value, or the other name for the market value is formula value. Just a second, I'm just type error is coming up. So formulae value, market value or formulae value is one thing you need to calculate, and market value is nothing but, what is a market value? Basically it's nothing but the higher of, as we mentioned in the summary sheet, the higher of, okay, conversion value or conversion value, and not or, conversion value and the value if considered only as a debt. Okay, so this is what you have to consider. So market value. Now there is another thing like floor value. Floor value is the value if value if floor value is a value if you are not converting the shares or converting the debt into shares. So basically what we'll consider, instead of a conversion value, we'll be using the redemption value and calculate the market value. So that will be the floor value you will be looking at. Now the other one is your conversion premium. Conversion premium is nothing but your conversion value minus you would be deducting what, sorry, not the conversion value, the um, conversion value. What is the conversion value? Basically conversion value is like what would be the value you're converting right now, and you are deducting that particular thing from your market value. So basically like it's not conversion value, so we need to consider the formula, that is market value which we have calculated in the first stage. Market value minus what is the current conversion value will give you the conversion premium. So conversion value, you need to deduct it from the market value to get the conversion premium. So the question might be asking for all three values over here, or just the market value of that only. Okay, now let's consider the workings over here. So first question is asking you, should the investors convert if the current share price is 4, 5 and 6? So we need to consider what would be the conversion value and what would be the redemption value to look at that particular case over here. So let's consider the question. So Excel company has an issue convertible loan notes with a coupon rate of 12%. Each 100 loan note may be converted into 20 ordinary shares at any time until the date of expiry, and any remaining loan notes will be redeemed at 100. So basically like we need to consider this particular thing over here. So loan notes have 5 years left to run. Investors would normally require a rate of return of 8% per year on a 5-year debt security. So what you need to consider, we need to consider the value of this particular thing. Okay, two values you need to consider. One value is like, if it is a debt, what would be the value? So you will be looking at here, since the required rate of return of the debt holder is 8%. We are not using a coupon rate. We are using what is the rate of a debt. If it is only a debt, what is the rate you will be looking at? So you will be having a convertible loan notes on year 1, 2. So redeemable in 5 years. No. So we are considering if it is debt, it will be redeemable in 5 years. Year 1 to 5, you have a cash flow of interest, and the amount is based on 100 multiplied by your coupon rate, that is 12%, right? Are we using coupon rate or are we using 8% over here? Think what use, think what it is, what would be the normal thing. So I already mentioned before, like whatever the cash flow, the amount will be calculated based on the coupon rate. So the coupon rate for the convertible loan note is 12%. So your interest is that only. So you have 12% of 100 over the 12 would be your this thing, and you will be calculating the present value at the required rate of return of the straight debt, that is a 5-year debt security, 8%. Now, on the year 5, another cash flow on the 5th year, I am considering whether this is being redeemed. Redemption is going to happen. So if it is going, redemption is coming up, what would be the value you will be looking at? You will be redeeming it on a, you will be redeeming it on what? You will be redeeming it on nominal value itself. So 100 would be the nominal value. Now, present value factor at 8%. What would be the value for 8%? Let's consider from the table 3.993. So it's 3.993 annuity factor for 5 years at 8% and 0.681 as a present value factor, 0.681 as a present value factor at 50 for the redemption value. So your present value would be, just multiply this particular thing, 12 into 3.993 and the same formula over here, 100 into 681, and just add it together to see what is your formula over here. So you will be having 116 as your market value of this particular, or the conversion value of this particular thing, meaning like if it is a debt, the total value or the market value would be 116 right now. So now you need to consider how much would be the equity value or conversion value you will be looking at. Conversion value, you'll be looking at three scenarios. Okay, first scenario, second scenario, and third scenario. Okay, share price is 4, share price is 5, and share price is 6. Now we need to consider like what is the conversion option. So their conversion option is like each 100 loan note may be converted into 20 ordinary shares. So every 100 can be converted into 20. So 20 shares over here. So let's consider the what would be the value over here. So 20 multiplied by what is the share price you will be having. Okay, so 80, 100 and 120. So in these two situations, like where the share price is 4 or 5, we are getting a particular value of 80 and 100, which is less than the current market value if it is being converted, or if it is not converted as a debt. 116 is the case, so conversion value is not that much. So again, now if you are considering the third case where this particular share price is being 6 over here, so it is giving you an indication, okay, rather than holding debt or redeeming the debt, it is better to convert. So we'll be looking at these particular things to say whether we are converting or not. So essentially like an equilibrium share price for conversion, where one would be looking like no profit no loss situation, would be 116.02 divided by how many shares we are looking at. 20 shares can be, for every 100 of a particular thing we can convert into 20 shares. So per share, if this is touching this 5.80 is the equilibrium price, basically equilibrium price. So if the share price is going above 5.80, how we have calculated equilibrium share price? The present value of, or the market value of this particular security, if it is being considered as only debt, divided by the number of shares if this particular one loan note is being converted into shares. So 5.80 is the equilibrium price on which we can convert this particular thing. Now relating to this thing, if the share price is going above 5.80, the market value would be number of shares being converted, that is 20 into the market price if it is above 5.80. But if it is below 5.80, the market value, if the share price is below 5.80, the share price would be, or the market value of this particular debt would be 116.02 only. Okay, so that is the case in here. So out of the three situation, we would be only converting with the third option over here. Now let's consider another question in detail, which is considering like three things. We are asking what is the market value, what is the flow value, what is the conversion premium. Okay, so let's read through the question over here. So PO company has an issue 8% bonds which are redeemable at nominal value of 100 in 3 years time. Alternatively, each bond may be converted on that date into 30 ordinary shares of the company. Now, the current ordinary share price of PO company is 3.30, and this is expected to grow at 5% per year for the foreseeable future. So debt holders of the PO company require a return of 6% and calculate the following current values for each 100 convertible bond. What is the market value, what is the floor value, and what is the conversion premium. So you need to calculate the market value. So as mentioned earlier, what is the market value? You are looking at the higher of conversion value and the value if considered only as a debts. So let's consider how this is being performed. So in this particular question, first thing is like market value. So in order to calculate the market value, okay, I'm just copy pasting this to this side so that we can work out these things together. Okay. Okay. So in order to calculate the market value, okay, so let's put in the cash flow timing over here. It's for 3 years. So year 1 to year 3 would be your normal cash flow of interest over here, and interest would be coming on a particular amount. Interest is how much? Interest would be coming on 8%, basically the coupon rate. So assuming that equal to, again, 100 would be the value into 8% would be your interest coming up, that is 8 again. And present value factor you need to consider at what percentage? Not at 8%. You would be using what is the required rate of a straight debt, that is 6% over there to calculate the present value. Now at year 3 we need to consider what is your cash flow that is being coming up here. So either this is redemption value or conversion value. This we need to consider. So whether we are calculating a redemption value or conversion value, to decide on that particular thing, you need to see, okay, on that particular date, what would be the conversion. So after 3 year, okay, at the end of the 3rd year, okay, what is your conversion value and what is your redemption value? Simply, what is your redemption value and conversion value? Redemption value is given in the question. It is being redeemed at 100 only, nominal value only, right? Redeemed at the nominal value of 100. So redemption value is 100. No calculation needed. Straightforward from the question. But for conversion value, it is being given in the question as like you can convert every 100 into 30 shares, right? 30 shares, 30 into, okay, normal share price today is 3.3. That is not a problem, that is 3.3, but this 3.30 is going to increase at the rate of 5% for this particular year. So we have how many years? Like 1 2 3. So 3 years it is going to increase at 5%. So 1.05 raised to, okay, the growth rate you need to consider 3. Okay, close it. So this share price, what would be the share price? 114 would be the conversion value and redemption value would be again what we have done. The share number for conversion is 30. Existing share price was 3.30. Okay, growth rate is coming as like 5%. Okay, now this 5% is increasing per year. So first year 5%, second year 5%, and third year 5%. Now the share price is increasing at that particular rate, meaning like 1.05 raised to 3 years we are looking at. So the share price would be now 3.82, meaning not now, after 3 years it would be 3.82. So we are converting this in the at the rate of 3.82 multiplied by 30. So that is the value 1146049. So while considering these two figures, okay, whether I am considering 100, when I'm redeeming, it is only giving a value of 100. So I am not considering a redemption. Since conversion is giving you higher value, I am considering a conversion. So first thing to look at whether calculating a market value is that whether I need to use over here redemption or conversion value, this column. So what we need to consider over here, redemption or conversion value. So in this case, since conversion value is higher, so we'll be considering the conversion value over here. So conversion value is coming as above 114.61 or 60 we can consider. What is the case? Okay, conversion value as calculated above. So this needed to be discounted at 6%. Now what is the discounted factors for this? Basic thing is like annuity factor for 3 years 6% annuity is 2.673. So I'm using 2.673 over here. And again, like you would be using the conversion value on the year 3, and year 3 the conversion value is how much? Conversion value is point, sorry, not the conversion value is present value factors 0.840. So 0.840 from the table. So you just need to multiply this thing. Okay, so 8 into 2.673, 21.8 thing. Same thing I'm applying over here, and we are totaling this particular thing to get the market value over here. So what is the market value of the debt? One debtor's market value is 117. So one debt is currently having a market value of 117 over here. So this is the market value. Okay, now the question, second question, what is the floor value? Now what is the floor value? We have calculated the market value. Floor value is nothing but same calculation I am using. Okay, now floor value is like I am considering, okay, not a conversion value. I am considering redemption value only over here. Since already other figures are there, I need to change the figure only, redemption at 100 only. So everything else is there. So your redemption value or floor value is 100. Everything else, since the formulas are already linked, I only changed what? I only changed your amount, redemption. Now instead of conversion, I am using a redemption value. This is what it is being changed over here. So when I'm using a redemption value, meaning like I'm not converting, I'm considering that this debt is not being converted. So this value is being considered, 100 is considered. This is your floor value over here. Now what is your conversion premium? What is your conversion premium? Conversion premium, your formula is nothing but you are taking a difference between what? You are taking a difference between your market value minus your current conversion value. Mind you, this is current conversion value, not after 3 years. So you need to calculate the current conversion value. So what is your current conversion value? Current conversion value is like you are converting it into the one debt can be converted into 30 shares. Okay, current share price is given as 3.30. So what is the current conversion value is? Basically nothing but 30 multiplied by 3.3. So current conversion value is 99 only. So current conversion value of 99 we are considering. Now what is your market value? Market value we have already calculated. Right, you have calculated the market value above. Right or wrong? Yes, we have calculated. No, so market value. I'm just linking the figure over here is equal to your market value is calculated as 117.66. Okay, so 117.66 versus 99. So your conversion premium is 117.66 minus 99. 18.66 is your conversion premium. Conversion premium is 8.66 per bond. Now normally this would be expressed as conversion premium. I'm just noting down the conversion premium as CP, conversion premium per share. Conversion premium per share. This is normally expressed that way only. So what you need to do, this 18.66 divided by, for this particular bond, how many convertible option is there? So 30 shares is there. So divided by 30, you will get $0.62 or 62 cents per share would be per share conversion premium over there. So these two things would be asked in the exam over here. So these are the calculations we are looking at. So just again looking at a calculation again, you can go through this calculation again and again. So if you have any doubt, you can just come back to me. Okay, through my Instagram page at the same name, Suma Tutor is there. You can reach out to me through that, and you can put any messages over there as well. Okay, so this is relating to the convertible calculation. So this part or this video was intended to calculate the value of the debt, or during the business valuation, how to calculate the value of preference shares, value of irredeemable debt, value of a redeemable debt, and value of a convertible debt. I hope everything is clear now. And if at all, as mentioned earlier, if at all any doubt, you can reach out to me through my Instagram page as Tumar Tutor. So that's it for the day. We'll come up with the equity valuation in the next video. Okay.